Hi everyone, welcome to a brand new episode. My name is Marcus and I'll be your host. In today's episode, we're going to look at McDonald's. If you're new to this channel, welcome. What we do here is that we study and analyze stocks. We go through the fundamentals and the technical aspect of a stock. We also talk about finance and investing. If you've been here before, thank you so much for coming back. Guys, I truly hope you will enjoy this episode. And please give me a thumbs up, comment, subscribe, and let me know what you think in the comment section below. All right, thank you. Now, let's get started. As I mentioned, we're going to take a look at McDonald's, and they are traded on the New York Stock Exchange and are in the trade and service sector. And if we go over to the screen, we can see that their market capitalization is at $200 billion and their revenues at $22.5 billion. Now, the PE ratio is at 27. Now, I like to take a look at companies with a PE ratio of 20 or below. So having 27, that is too high for me. Now, I understand it's not far from the threshold. You want to be flexible, but it's still higher than what I normally like to take a look at. So that is a no for me. When you see a stock with a high PE ratio, that tells you that the market expectation of that stock is high, and therefore you might see capital gains on those stocks. But but the looming risk is if the company doesn't meet those expectations, we will see the stock price fall. Same thing goes when you see a stock with a low PE ratio. That tells you that the market expectation of that stock is low, and therefore you might not see capital gains on those stocks. Now, their profit margins at 32%. I like it because I like to take a look at companies with a profit margin of 15% or higher. So having 32%, I like it. So that is a go for me. Now, the price to sales ratio is at 8. Normally, I like companies with a price to sales ratio of maximum 4. I understand 8 is not far from the threshold. You want to be flexible, but it's still higher than what I normally like to take a look at. So that is a no for me. Now, we don't have any price to book value data, but normally I like companies with a price to book value of maximum 3. They pay out a dividend of $5 per share. I like it because I like those dividend income. So that is a go for me. Now, the effective return, 2%. Now, I understand it's not high, but if you look across the market, this is what you might find. So 2%, I like it. But you want to be careful because I know companies that have a return of 6% or higher, and you might think, oh, well, I like it, and you buy it and you get a good return on those stocks. But the risk is it could be a trap, because if we look across at the chart, you might not have capital gains on those stocks. So therefore, a risk is when you want to exit the stock, you might not get a price that is higher than what you bought it for. So be aware of that. Now, return on equity, I have to report those data, but normally return on equity tells you as an investor about a company's ability to create a return on their equity, and you want to make sure you have a company that is able to create a return on the capital you're about to invest in them. Now, return on assets is 11%. I like it. So that is a go for me. Now, the stock is currently traded at $268 per share. If we go over to the 50-day moving average and the 200-day moving average, we can see that we are the price is higher than the 50 and the 200-day moving average. So this is a signal we might see the stock price continue to rise. If we take a quick glance at the chart, we can see here on the yearly chart that we are trading within a positive trend channel, and it's actually touching the resistance level. But if we were to take a look at the signal, then the price might go even higher. But we'll go through the technical aspect of the stock further down. But let's jump over to the income statement. And what we are interested in here is that the total revenue 2016 went from $24.6 billion down to $19.2 billion in 2020. And we can see here that we have been growing. We fell off 1 year, 2 year, a couple of years, but so the overall trend here is negative. So that is a minus. Now, the gross profit went from $19 billion down to $15.2 billion and have been falling every year. So we grew 1 year, but overall trend is negative. So that is a minus. Now, the net income went from $4.7 billion and landed on $4.7 billion in 2020. But we can see here that we have grown several years. So the overall trend here is positive. I like it. Now, let's jump over to the balance sheet. And what we are interested here is that the current assets versus the current liabilities. And we can see that both of them is at $6.2 billion. If the company were to convert the current assets to cash, they're able to pay off their current liabilities, which is great. But a minus side is that they won't have any capital left. So that is a minus. But still, being able to pay off your current liabilities, I like it. So that is a plus. Now, we are far from being able to pay off our long-term liabilities, and we can see here that the total liabilities ended up in 2020 at $76.7 billion. We started off with $32.4 billion and have been growing every year ever since, and we can see a huge jump between 2018 and 2019. But I want to see the company start reducing their overall debt. So this is minus. I want to see, as we can see, the debt has been growing. Now, over to the outstanding shares, we can see that we went from 823 million outstanding shares down to 745 million shares, and the numbers have been falling every year. I like it. So that is a plus. There's a lot of investors that either skip this part or doesn't know about it, and some even call it the silent killer, because what happens here when you see a company doing buybacks, that means that your share of the company is growing. And there's a lot of investors that have been looking at the balance sheet and they see the company, a company with a lot of assets, and the debt is not growing, and they'll be like, well, this looks great. But on the other side, on the other hand, we can see that the company is issuing a lot of shares, and that's a way for a company to bring in more capital without taking on more debt. And what happened is that your share of the company is being diluted, is decreasing. So seeing that McDonald's doing buybacks, I like it. So that is a plus. Now let's jump over to the cash flow, and what we are interested here is that the operating cash flow versus the capital expenditure. And we can see here that the cash flow in 2020 landed at $6.3 billion, and the capital expenditure landed at $1.7 billion, and we can see here a difference of $4 billion. I like it. So that is a plus. We can also see that the capital expenditure have grown from 109 million up to 1.7 billion. So I like it. I like to see them continue to invest in the business. Let's jump over to the key figures. And what we are interested here is that the earnings per share, we can see, went from $5.6 per share up to $6.3 per share. And the numbers have been growing every year. We fell off the last year, but I believe it's due to the pandemic and the shutdown of overall economy. But the overall trend is positive. I like it. So that is a plus. Now, the revenue per share went from $29.8 per share down to $25.7 per share, and we can see here the number, a bit of fluctuation, but overall trend is negative, so that is a minus. Now, the equity per share went from negative $2.6 per share down to negative $10.5 per share, and we can see here the numbers have been falling every year. I don't like it at all, so that is a minus. Now, dividend per share went from $3.7 per share up to $5, and it has been growing every year. I like it because I want the income, but also I want the income to grow every year, so that is a positive thing. Now, dividend share went from 65, a bit of fluctuation, 65, 59, 54, and here they paid out 79%. I like companies that pays out less than 60% because I want some of that capital to remain in the business for acquisitions, for investment, or overall strengthen the financial strength of the company. So seeing that they are below 60% overall years, but the last year they paid out a lot more, but overall trend is positive. I like it. Now, gross margin went from 77% up to 79%, and we fell off 1 year and then a couple of years, but overall trend is positive. I like it. They are becoming more and more efficient, which is a plus. I like that. Now, the operating margin went from 76% 27.8% up to 31.9%. And also we can see that the numbers are growing. We fell off 1 year, but overall trend is positive. A bit of fluctuation, but overall trend is positive. I like that. Now, profit margin went from 19% up to 24.6% and has been growing steadily every year. I like it. Now, return on equity went from negative 212% and up to negative 60%, and we can see that the numbers have been improving every year. I like it. Now, you want a positive return on equity, so this is basically negative, but looking at the overall behavior, they are doing better and better every year, so that's why I gave them a plus. Now, return on equity tells you about the company's ability to create a return on their equity, and you want to make sure you have a company with a positive return on equity, because that means they are able to create a return on the capital you invest in them. So that is critical, and the main reason, as I mentioned, that I gave them a plus, because the numbers is improving every year. Now, return on assets went from 15% down to 8.9%, and we can see we did a good a couple of years, but then the numbers have been falling. So this is a minus. Even though you have some fluctuation, but the overall trend here is negative. So that is a minus. Solidity tells you about the company's financial strength for the long term. And we can see that we went from -7 down to -14, which is a minus. Now, balance sheet liquidity, same thing as solidity, but here it looks at the company's financial strength for the short term. And we can see we went from 0.16 and down to 0.12, and also that the numbers have been falling every year. That is a negative. I want to see them improve their financial situation. Now, debt ratio went from negative 15.6 up to negative 8, and we can also see that the numbers have been improving, decreasing every year, so that is a minus. Even though last year we had negative 9, that means that the company has 9 times more equity than debt, but we can see that the number is not improving every year, so that is a minus. Now, guys, we have gone through the income statement, the balance sheet, the cash flow, the key figures, and now over to our key features, which is our pillars. And basically what the pillar does, it gives you a simplified, holistic overview about the company's performance. If we go down to the screen, we can see that the PE ratio is above 20, which is negative. They pay out a dividend, which is positive. Now, the dividend payout share is greater than 60%, which is negative. And the dividend increased over the past 5 years, that is positive. And the number of outstanding shares have decreased over the past 5 years, which is positive. And revenue decreased over the past 5 years, that is negative. And the profit margin is above 15%, that is positive, and the profit decreased over the past 5 years, that is negative. Current assets is greater than the current liabilities, or it's the same. They are at least able to pay off their current liabilities, which is a positive. And solidity decreased over the past 5 years, negative. Balance sheet liquidity decreased over the past 5 years, negative. Debt equity ratio increased over the past 5 years, negative. And total liabilities have grown for the last 5 years, that is negative. Guys, as you can see, it gives you a simplified, holistic overview of the company's performance. If you want to dig through the numbers, you can dig through the numbers, or you can have the software do the heavy lifting for you. You can have everything we've gone through, plus the pillars, and be able to chat with me alongside other members for only $10 per month. So make sure to go over to commerce.sc and become member today. All right. Thank you. Now let's jump over to the technical aspect of the stock. So here we have the chart. Let me start with draw the support line, something like this. And let me do for the resistance line, something like that. And let me change that color to red. And what else? We can see that we have a resistance support line, something like this. And let me change that color to green. And let me see here. So we can see here that we are within a positive, moving in a positive trend channel. We can see we have higher lows, and higher highs. So we are in a positive trend channel, but we also can see that up here we are moving in a ascending triangle. So as we saw earlier that the price is higher than the 50 and the 2-day moving average, basically signaling that we might see the stock price continue to rise. So we could see something like the stock going up here, continue up here. If it breaks the resistance line and it does a retracement and for another pullback, if it does that, then I would enter up here. But there is a looming risk because we have to look at how much can it move up to the resistance level and how long will it take, because we have some risk in the market right now. The Fed just increased the tapering, and also they said that we will see 3 interest rates hikes in 2020. So that could hit the stock markets, and we could see the stock price fall and see a lot of investors move their capital. If the price goes back down to the support line right here, then that would be a major buying area. So that's where I would enter because the company is strong, it's looking good, it's developing in the right direction. But sure, they need to improve their the solidity and balance sheet. The debt needs to start go down a bit, but overall performance of the companies is looking good. And so I don't see anything that really could disrupt the price if then having that the Fed is increasing the tapering and the interest rate size, which could affect the price. So if the stock continues to grow to expand up to the resistance level, that is a key area to watch. If it breaks up above it and retrace and then pulls back up again, then we have a buying area. But otherwise, just wait and see. And if the stock start moving down, then there's a lot of buying opportunities here, and also the dividends is great, so I like it. So that's how I would trade the stock. How would you trade the stock? Please let me know in the comment section below, and thank you guys for watching this episode. I truly hope you will enjoy this one, and please give me a thumbs up, comment, subscribe, and let me know what you think. Until next time guys, thank you once again for watching. Bye bye.